Welcome to Charged Alpha. I'm Hudson, joined by Lana. Today's chapter, Doximity, the physician platform reporting record revenue as AI workflow tools deepen engagement.
Doximity was co-founded in 2010 in San Francisco by Jeff Tangney and Stanford colleagues. The company built a HIPAA-compliant physician network with clinical messaging and collaboration tools.
Doximity listed on NASDAQ in June 2021. Today, over 2 million healthcare professionals use the platform, including more than 80% of U.S. physicians.
Most recently, Doximity reported quarterly revenue of $177 million, up 21%. Non-GAAP gross margin was 78%, and EPS beat consensus estimates.
Revenue is driven by pharma companies and health systems paying to reach Doximity's physician audience. As AI tools increase engagement time, pharma clients expand media budgets on the platform.
Full-year revenue grew above 20%, with non-GAAP operating margins above 50%. The company generates over 40 cents of free cash flow per dollar of revenue.
Doximity's moat is physician reach. With 80% of U.S. physicians on the platform, pharma companies cannot effectively target American doctors without it. That dependency is structural.
Network effects deepen the moat. More physicians joining to collaborate and share clinical content makes the platform more valuable to pharma advertisers, a flywheel that took 15 years to build.
The AI thesis is workflow automation. Doximity's AI tools, including note dictation and clinical summaries, increase physician time on platform, expanding the audience pharma companies pay to reach.
Against Veeva systems, Doximity competes on physician engagement depth. Veeva leads in pharma operational software, but Doximity owns the physician side of the relationship through daily workflow.
Pharma digital marketing is the structural opportunity. Drug companies spend $5 to $6 billion annually reaching U.S. physicians. Doximity captures a growing share as digital replaces in-person detailing.
The near-term risk is pharma budget volatility. Marketing spend is tied to drug launch cycles. A slow launch year or budget reallocation can slow Doximity's growth rate meaningfully.
Jeff Tangney has been CEO since co-founding Doximity in 2010. A Stanford computer scientist with clinical workflow domain knowledge, he built the platform to profitability without significant dilution.
Execution risk centers on AI monetization. Workflow tools must convert physician usage into measurable pharma ROI. If that data story weakens, advertisers can redirect spend to competing channels.
AI monetization is the primary catalyst. As Doximity packages workflow data into pharma targeting products, revenue per physician should expand beyond the current advertising model.
International expansion is option value. Doximity's model is proven domestically. Entry into European or Asian physician networks would open a market comparable in size to the U.S.
At $12 billion in market cap on $630 million in annual revenue, Doximity trades at a software premium. The multiple reflects margin excellence and structural network lock-in.
Doximity just reported record revenue. AI workflow tools are turning the physician network into the most efficient marketing channel in American pharma.
Let's get into the physician network flywheel and what AI monetization means for the platform's growth ceiling.
Physician reach, AI tools, and 50% operating margins, Doximity is building the definitive professional platform for American medicine. Let's get into the numbers.
Doximity built the LinkedIn for doctors, serves over 2 million verified U.S. physicians, and just posted a 14th consecutive quarter of profitability. So why did the stock crash nearly 19% after hours tonight? Because the guidance was not good enough. Q4 fiscal 2026 revenue beat, EPS missed, and fiscal 2027 guidance came in well below what Wall Street wanted. I'm Hudson Thomas. And I'm Lana Chen. This is a story about a high-quality business with an exceptional moat running into a painful reality. AI is costing them money now, and monetization is at least a year away. Today we walk through every number, every risk, and the question every current shareholder has to ask themselves. Is this a buying opportunity or a warning sign? Let's find out. Doximity was founded in 2010 and is headquartered in San Francisco. CEO Jeff Tangney, one of the co-founders, has led the company since inception. The core business is a professional network for physicians. Think LinkedIn, but verified, HIPAA compliant, and built specifically for clinical workflows. The company has over 2 million verified members, covering roughly 80% of all U.S. physicians. Revenue comes primarily from pharmaceutical companies that pay for targeted digital marketing and from health systems that subscribe to workflow tools. With only around 900 employees, the operating leverage is remarkable. The investment thesis on Doximity has always been simple: an unassailable moat in physician trust, best-in-class software margins, and a long runway of pharma marketing dollars shifting from legacy sales rep visits to digital outreach. For several years, that thesis worked beautifully. Full-year fiscal 2026 revenue hit a record $644.9 million, up 13% year over year. The problem is what comes next, and tonight's guidance revealed that next year looks a lot slower. Let's go through the Q4 fiscal 2026 numbers. Revenue came in at $145.4 million versus a $144 million estimate. That is a beat, barely about 1%. Year-over-year growth was roughly 5%. For context, Doximity generates most of its revenue in the first half of its fiscal year because pharma marketing budgets are front-loaded. Q4 is structurally their seasonally softer quarter, which makes the comparison easier, and they still only grew 5%. EPS, non-GAAP earnings per share, came in at 26 cents, missing the 28-cent estimate by 2 cents, or 7%. That miss is not catastrophic in isolation, but when you see the source, AI compute costs, it changes the narrative. Non-GAAP gross margin fell from 91% to 89% year over year in Q4, driven entirely by the ramp in AI infrastructure spending. Management said on the call that AI usage is growing faster than overall platform engagement, which is impressive from a product perspective. But the compute bill is arriving before the revenue. For the full fiscal year 2026, revenue was $644.9 million. Operating cash flow rose 19%. Free cash flow rose 19%. These are genuinely excellent full-year metrics and reflect how efficiently Doximity converts revenue into cash. The company held $580 million in cash with zero debt, a pristine balance sheet. But Wall Street is a forward-looking machine, and the forward was the problem. The guidance for fiscal 2027, revenue of $664 million to $676 million, which implies roughly 4% growth at the midpoint. The street was at $697.6 million. That is a gap of more than $20 million, or about 3 percentage points of growth. Adjusted EBITDA margin guidance of 49% signals that the company is committing to profitability, even as it invests in AI. But that does not help if the top line is decelerating. Management acknowledged that AI revenue will not be significant until later in fiscal 2027 due to regulatory review timelines. Let's talk about analyst reaction. Heading into tonight, the consensus on Dox was essentially a hold: 7 buys, 12 holds, 3 sells across 22 analysts. The average price target was $39.14, implying meaningful upside from the pre-earnings price around $30. After the guidance cut, expect that average target to move lower as analysts recalibrate for 4% growth instead of 10 to 12%. Needham was one of the more vocal downgrades, moving from buy to hold. Their argument: at a premium valuation, the stock was trading at over 15 times forward revenue before tonight. You need growth to accelerate, not decelerate. A 4% revenue growth year paired with AI cost pressure is simply incompatible with a high-growth software multiple. Morgan Stanley and Piper Sandler both held their neutral ratings, with targets in the $28 to $32 range. The bull camp did not disappear entirely. Several analysts noted that Doximity's platform engagement metrics were strong, that the AI usage ramp is a real signal of product-market fit for its clinical tools, and that pharma digital marketing budgets should recover as macroeconomic uncertainty settles. But the timing question: when exactly does AI monetization kick in and offset the compute cost headwind, has no clean answer. And that uncertainty is exactly what you see reflected in a 19% after-hours sell-off. The high-end price target from one firm is $60, about twice the current after-hours price. The low end is $25, implying further downside. That enormous range tells you everything about how divided the street is on Doximity's AI monetization timeline. This is a conviction call, not a consensus trade, and that creates volatility in both directions. Here is the bull case for holding or buying the dip. Doximity controls 80% of U.S. physician relationships. That network took 15 years to build and cannot be replicated quickly or cheaply. Pharma companies have no meaningful alternative for verified digital outreach to prescribers at scale. The AI investment is compressing margins today, but if the clinical AI tools meaningfully improve physician productivity and deepen engagement, Doximity becomes stickier, which means pharma clients pay more and churn less. Add the balance sheet. $580 million in cash, zero debt. The company is buying back stock and has the financial flexibility to weather a growth trough without raising capital. If you believe the AI monetization kicks in during the back half of fiscal 2027, as management suggested, you have a window here where the stock is being priced for permanent deceleration when the reality may just be a temporary investment cycle. The free cash flow yield at this price is actually compelling for long-term holders. The bear case centers on valuation and the growth deceleration. Even after tonight's sell-off, Doximity is not cheap. At around $26, you are paying roughly 22 times forward earnings and over 14 times forward revenue for a company guiding to 4% top-line growth. That is a valuation premium that demands a re-acceleration story, and management just told you it is at least a year away. The pharma advertising dependency is the structural risk that keeps appearing in bear theses. Doximity generates the vast majority of its revenue from pharma companies buying physician access. Those budgets are cyclically sensitive, tied to drug approval pipelines, and subject to policy risk. The FDA policy environment in 2026 is uncertain, and any slowdown in drug approvals cascades directly into Doximity's forward bookings. There is also competitive pressure from health systems building their own physician communication tools and from larger platforms like Microsoft and Epic embedding clinical AI into existing enterprise software. If Doximity's AI tools get commoditized by a larger vendor with deeper pockets, the moat narrative weakens quickly. None of that is happening today, but at a premium valuation, you are paying for a long runway, and any narrowing of that runway gets punished hard. Options and insider signals were both telling a cautious story ahead of tonight's print. The put-call ratio on Dox ran at about 1.42 in the days before earnings, meaning put buyers outnumbered call buyers almost 1.5 to 1. Options traders were pricing in a double-digit move in either direction, with the skew tilted toward protection. After the EPS miss and weak guidance hit the tape, those short-dated puts were rewarded as the stock plunged nearly 19%. On the insider side, Doximity's interim CFO exercised options and sold 2,300 shares under a pre-established 10b5-1 plan ahead of the report. These are scheduled sales, not a directional signal. CEO Jeff Tangney, a co-founder with a large equity stake, has not made open market purchases in recent quarters. Neither of those data points is a red flag on its own, but the absence of any insider buying, ahead of what management knew would be a soft guidance quarter, is worth noting. If insiders believed the stock was materially undervalued, you would typically see at least some opportunistic purchases. The catalysts I'm watching over the next 12 months. First, AI monetization. Management says AI revenue becomes meaningful in the back half of fiscal 2027. If they can demonstrate a premium AI product tier, a subscription that physicians or pharma clients pay more for because of AI-enhanced targeting, that changes the growth narrative completely. Second, pharma budget recovery. If macroeconomic conditions stabilize and drug approval pipelines normalize, pharma digital ad spending should recover, which flows directly to Doximity's revenue. Third, share buybacks. With $580 million in cash and zero debt, the company has firepower to opportunistically buy back stock at these levels, which would support earnings per share even during a revenue growth trough. The risks to keep in focus. Gross margin is the key number to watch. It fell from 91% to 89% in Q4. If AI compute costs keep rising and gross margin drops to 85% or below, EBITDA margin guidance of 49% for FY 2027 becomes a stretch target. The second risk is guidance credibility. Management has now guided below consensus for the second consecutive fiscal year. If FY 2027 guidance also proves too optimistic, the stock faces a second round of multiple compression. Trust, once broken with the street, takes several quarters of beats to rebuild. Bottom line, Doximity's Q4 was a revenue beat wrapped in an EPS miss and soft guidance. The company's underlying business, physician network, cash flow, balance sheet, remains strong. But tonight the market delivered a verdict. 4% revenue growth is not compatible with a premium software valuation, and AI monetization is not yet close enough to offset the cost headwind. This is not an existential crisis for Doximity. The moat is real, but the $26 after-hours price suggests the market is demanding show-me quarters before rebuilding the premium. If you own it, the question is whether your time horizon extends beyond the AI investment cycle. If you don't, this is a stock to study closely as the FY 2027 AI monetization thesis unfolds. Doximity built something genuinely rare, a trusted professional network inside one of the most regulated industries on Earth. But right now, the market is asking whether that moat is wide enough to justify a premium when growth is slowing to single digits. That is the question every investor needs to sit with. We are Charged Alpha. Subscribe for a new deep dive every earnings season. This content is for educational and entertainment purposes only and does not constitute financial advice. Charged Alpha is not a registered investment advisor. Always do your own research before making investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.